How much stress would evaporate out of your life if you were debt-free, including your mortgage? Would your retirement look better if you had no debt? Would you retire sooner? Picture your house paid off, school debt is gone, car loan doesn't exist anymore, and credit cards are at zero. Imagine how different your future would look, sound, and taste. Would your relationships be better? Would you spend more time with the people you care about? There is a way to become debt-free, including your mortgage, without spending any more money than you are spending now. Would you want to know? I'm going to share with you, in a few short minutes, what the truly wealthy already know. First, here's what most people do. Not the truly wealthy. Most people derive income from a job, business, or pension, and before they even get that paycheck, money is deducted to go into a tax-deferred retirement account, like IRAs, 401ks, 457s, and 403bs. Then, taxes take a big bite. After all those deductions, now the money goes into the bank. How much does the bank pay you for the privilege of using your money that they use to make money lending out to other people? Is it pretty much nothing? Next, on top of paying living expenses like food, utilities, cell phones, internet, clothing, and hopefully some fun, then money is spent on servicing debt. People pay debt in the form of mortgages, car loans, student loans, home improvement loans, and credit cards. Some people attempt to reduce the amount of debt they have by paying extra each month. $25 here, $50 there, $100 on that one. For most people, it doesn't seem to make much of a dent, and the hamster wheels keep spinning faster and faster. Some people have a system of paying off debt called Debt Snowball. Have you ever heard of that? Debt Snowball is a debt reduction strategy where you list all your debts from the smallest to the largest amount owed, and you pay the minimum on every debt except the smallest one. That one you pay as much as possible until you pay off the debt. Then, once the smallest debt is paid, roll that minimum payment plus any extra over to the next debt on the list, and then repeat that with debt after debt until all your debts are paid off. The amount paid on the debt grows, it snowballs, with each debt that is paid off. This is a good method to accelerate the payoff of your debts. The drawbacks are that when you make these overpayments to the creditors, that money is now gone, never to be in your control again, and the only way to get back the money if you need it is to borrow it again under their terms. In addition, even though you have sent in all those extra payments, if at any point in the repayment process you are unable to make the scheduled monthly payment, let's say due to an unexpected layoff or other financial bumps in the road, you are in jeopardy of having it reflect negatively on your credit, or worse, having the collateral, the house, car, etc., taken away. Here's a better plan that will 10x the results without the negatives. We're going to use a financial tool that can accelerate the paying off of your debt, called Debt-Free Life. Like banks, insurance companies also have accounts where you can save money. It's called a participating whole life policy. It is a special kind of insurance policy that is designed as an asset to accumulate savings and create wealth. This is how it works. A small portion of your monthly premium is used to pay the insurance portion of the policy. The larger portion of your monthly premium is put into the savings portion, called paid-up additions, that will grow tax-deferred, accumulating compound interest for the life of the policy. The nice part is, you have access to that money anytime you wish, for any reason, just like you would if you had money deposited at a bank. You are now the bank. The concept is also called infinite banking, and the wealthy have been doing this for years. Remember how the bank didn't pay you any money for the privilege of holding your money? The insurance company will pay you for holding your money in the form of interest and dividends. The guaranteed interest is 4%. Compare that to what the bank is paying right now in your checking, savings, money market, or CD. On top of the interest, the insurance company will pay you a dividend based on the overall profitability of the company. The dividend has averaged 6% annually, and the insurance company has been paying this dividend over 100 years. That means it has paid this dividend through numerous market losses, high interest periods, depressions, and recessions. 4% plus 6% equals 10%. This is why you want the savings portion to be as large as possible. That's a pretty good return on an account where the funds are liquid, there is no risk, and grows using compound interest. Wouldn't you agree? Here are a list of some of the benefits using this financial strategy. First, it is a private asset and you are in complete control. We will now call this your family bank. When your money is inside your family bank, you earn guaranteed interest and annual dividends that grow for life, tax-free. Leveraging this money is how we accelerate the process of becoming debt-free. This strategy allows you to have your money in more than one place at a time. You receive protection in the form of a death benefit in case you die that is tax-free and protection from creditors in case somebody tries to sue you. There is zero market volatility, which means there is no losses ever. You can also use it as a tax-free retirement option. Because the money is liquid, you can use that money to buy big purchases such as a car or college tuition, wedding, buying additional property, investments, the list is endless. All the while, the money is in your policy earning an average of 10% compound interest. Did you know Disneyland was financed using this same strategy? Here's the process. Start the policy by redirecting existing funds that you're already spending or a lump sum into the policy while at the same time only paying minimum payments on your debts. Now, remember that debt snowball idea? Here is how to maximize results. When the policy balance gets to the point of being able to pay off that first debt, take out a loan from the insurance company using the policy death benefit as collateral. Yes, I said loan. You don't want to withdraw money from the policy. Using a loan has two huge benefits. First, the compound interest on your money is allowed to continue uninterrupted. Secondly, the money received on a loan is tax-free. You then pay the debt off and then snowball that payment back into the policy, increasing what you're contributing to the policy. Then, do it again and again. Do you see how the combination of snowball and compound interest accelerates the amount of money available to pay off your debts? The result is a much faster payoff. In addition to that, your money is working in two places at the same time. Your money is earning compound interest and paying off your debts. Let me show you a real-life example. Michael and Jennifer had been working to pay off their debts. Not using the Debt-Free Life program, their current pace to pay off their debt will take them 25 years and 3 months and cost them tens of thousands of dollars in interest. Their consumer debt is currently $52,297. By the time this is paid off, they will have paid an additional $21,435 in interest. That's 41% of their payments going into the pockets of the bankers. Their mortgage is currently $235,698. By the time this is paid off, they will have paid an additional $77,946. That's a full third of their payment going down the black hole of interest. Combining consumer debt and mortgage debt, that's nearly $100,000 evaporating into interest. Their real debt is $387,376. Enough of the bad news. Here's the good news. Using the debt-free life strategy where we combine the two concepts of debt snowball and infinite banking, their 5 credit cards will be completely paid off in 2 years and 1 month. Their car will be paid off the next month. Their student loan 7 months later, and they will be 100% debt-free, including their mortgage, in 11 years and 7 months, instead of 25 years and 3 months. Even better, they will become debt-free without spending any more money each month. Here's the numbers. Now that Michael and Jennifer are completely debt-free, their family bank is now going to start to really compound. In 20 years, their family bank will be projected to have $307,095 in total assets. Once the debt is paid off, then the cash flow can be reallocated as a complete savings vehicle to accumulate wealth. In 30 years, they are projected to have $749,932 in total assets. And because this policy just keeps growing and growing, in 40 years, they are projected to have $1,258,930 in total assets. This is how their family can begin to create wealth for generations. Here are your next steps. Find out how soon you can be completely debt-free. Schedule a free, no-obligation consultation in the link below.